I've got quite a few topics to cover today. I have the warning screen here that is going to flash at me if I talk too long, so I will try to keep it contained and not give you every chapter and verse of the things that we are working on, but obviously if there are things that you want to know about and we haven't covered it here today, happy to try to address those in questions afterwards. So just in terms of the topics that I want to look at in the presentation this afternoon, apologies. I wanted to start with a very broad overview of what's going on in superannuation at the moment. And obviously at the moment we have some elements of the stronger super reforms that still need to bed down, and to a certain extent nobody really knows quite what's going to happen to FOFA. And then over the top of all of this we have the financial system inquiry, which is asking some fairly big questions, not only of the superannuation sector, but of the financial sector in this country more generally. And the financial system inquiry really could change the direction of where we all end up, regulators and industry alike, in the years to come. I'll also touch on the deregulatory environment that we're in at the moment and talk about some of our red tape cutting measures. But at the outset, I thought what I would do is talk about ASIC's second submission to the FSI, which you've probably seen up on the website, and I know AIST has also put in a submission. At a very high level, you're probably aware that ASIC has made submissions about expanding its regulatory powers, including to have intervention powers, which you've no doubt seen in the FSI's report. We also support a self-funding model that would enable ASIC to achieve better regulatory outcomes by adopting a more autonomous budget funding process. And again, you're probably familiar with that from an APRA perspective. However, I also want to talk today about some of the very specific comments that we have made that might be of interest to this particular audience. We think that ensuring the super system better meets the needs of consumers entering retirement is very important. It's a point that we made in the first submission and we've reiterated again in the second submission. And to that end, we would support consideration of default products in the retirement phase of super, and in fact, more broadly, we support the idea of default products in appropriate circumstances, so that might include things like general insurance as well. We're also supportive of the FSI's report where it talks about looking at this stage at fees and costs in the superannuation industry, and many of you are probably familiar with the recent report that we have released in relation to fees and costs disclosure. In the context of SMSFs, we didn't support the introduction of a mandatory minimum balance in SMSFs, which I suspect people might have anticipated that we would. We recognise that there are times when minimum balances where having a small amount of money in an SMSF might be entirely appropriate, so we didn't want to end up in a situation where it's mandated as to what the minimum balance must be. However, coupled with that, we do think it's appropriate to have some fairly clear guidance as to what a minimum balance is likely to be or what minimum balance is likely to be appropriate. And that's the sort of guidance that potentially could be given by ASIC. I also want to touch very briefly on markets, and in a funding sense we think that market forces and tax barriers are the most significant deterrents to the development of a liquid retail corporate bond market in Australia, and relaxing disclosure requirements probably won't do that much to develop that market. We also support further financial integration and the exploration of passporting, particularly say to the US, and again this may give access to US retail securities including bonds. We've made some further comments more generally about disclosure in our submission, and this is again relevant in the superannuation context because obviously disclosure is something that all superannuation trustees need to think about. We recognise that one size does not fit all in disclosure, and in fact we support a layered approach to disclosure where information is given to people as they need it. We're also aware that we need to keep up with developments in terms of the electronic age, and in terms of the delivery of some of this material. And we do support well-designed web comparison tools as well, more broadly than super, again perhaps into things like general insurance, but we do recognise the value to consumers in those types of sites. Just touching on and continuing on from the comments about the FSI, I mentioned that all of the government agencies and departments have deregulation targets and a focus on cutting red tape. And it's probably opportune to mention now that in our report 391 in relation to our deregulatory initiatives, we've focused quite a bit on electronic disclosure. So in addition to the comments that we've made to FSI, we do recognise that ASIC also has a role to play in looking at removing anything that might be a barrier potentially to innovation in terms of electronic disclosure, and would welcome your thoughts and feedback on this. Not that electronic disclosure is by any means the only area of focus for deregulation for us. We're also reviewing things like our old class orders to see whether some of them are still appropriate, and certainly when you look back through the list of our class orders, you realise that the world has often moved on and perhaps some of those need to be revisited. We're also looking at things like forms and processes to see where we can start to cut back some of the red tape. In a superannuation context, I'm sure all of you are aware, but we've removed the fee information that you used to have to fill in on the PDS and use notices. It's a relatively minor change, but hopefully that does make people's lives slightly easier. Now, I've spoken quite a bit about the broad context in superannuation at the moment and some of the issues that obviously we're all grappling with, but I did want to talk a little about the specifics of the things and the reforms that are here now and the things that we're all grappling with on a day-to-day basis. I want to begin with my super product dashboards, which are here now and have been here since, since the start of the year essentially. And I have to say, from a regulator's point of view, it does look as though it's so far so good. Now, product dashboards are the quick summary pieces of information for consumers about risk, return targets and fees that help people to engage with their super and perhaps compare across my super options. You'd be aware that we gave some guidance late last year in info sheet 170 and that we included a mock-up with that info sheet, which was based on some of the results that we got from the consumer testing last year. It's pleasing to see that actually that mock-up seems to be well adopted in the industry, so hopefully it's been very useful to you. However, we have updated info sheet 170 following some review work that we undertook earlier this year, and the info sheet in particular has been updated to emphasise the importance of making sure that the product dashboard is prominent on a trustee website, and it isn't cluttered with additional information that might take away from some of the key messages that the dashboard includes. There are a few other additional things about the updating requirements that have also been included in info sheet 170, so it's well worth a look. I also wanted to note that we currently have a class order that provides relief to allow periodic statements to include the product dashboard by hyperlink. Obviously that interim relief runs out fairly shortly. We've got some relief applications on foot at the moment and we're actively considering whether we extend that relief a little further. So you should hear something further about that very soon. What I want to focus on today though is really the choice product dashboard, because although the choice product dashboard has been extended until 1 July 2015, as all of you would be aware, there's actually been quite a bit of activity on choice product dashboards recently. And in particular, and following the announcement from the Minister on the 5th of May that mentioned consumer testing, ASIC has been undertaking some consumer testing of the choice dashboard in anticipation of some further regulations and consultation from government. So this is very early stages. The final version of the report from Latitude Insights, our researchers, has only just arrived on our desks. We're still packaging it up to send to Treasury. So the comments I'm going to make today are going to be fairly high level, obviously in recognition that Treasury hasn't seen it just yet. There are a few things that are worth flagging right at the very beginning. When we sat down with Treasury and we thought about the type of testing that we wanted to do, we did have regard to some of the feedback that the industry gave the government in its governance and transparency consultation paper. So, for example, ASFA was critical of the fact that our previous testing for the My Super dashboard only covered, I think, 55 people and they thought the sample size was too small. So we more than doubled it. There were 120 people in this particular sample. AIST commented that it would be good to test another risk measure, particularly looking at longevity and looking at the probability or otherwise as a percentage of underperforming inflation in the longer term. So we took those comments and we tested that in this round as well. And it's been very valuable to have that industry feedback to feed into the consumer testing for the choice dashboard. So in a very general sense, we found that the response from the consumers to the choice dashboard depended on many things, but included their reported level of financial awareness. So it depended on whether they thought they had low levels of financial literacy or whether they had higher levels of financial literacy. Obviously, people with high levels of financial literacy have a little more confidence in what they're reading. The testing also highlighted how sensitive people are to very small changes in the detail of the dashboard, and by changes I mean things like changes to terminology or changes to formatting. It also highlighted for us how very difficult it is to find something that suits everybody, and I'm sure all of you have struggled with that when you're preparing disclosure material, to try to find something that will work for everyone. Some of the specific comments that we got back I thought I'd share with you today. We found, and this follows on from some of the things we found in the first round of testing, people like the idea of industry averages. It gives them a sense of where they sit in the sort of superannuation sense more generally, whether their fund is, say, middle of the road when it comes to fees or whether the fees are slightly higher. But this time around, people commented that it wasn't just fees that they liked the idea of an industry average for, they also liked it for returns and return targets as well, which we thought was interesting feedback. We also found that people were very sceptical of less than 5 years of return data, particularly where you're talking about a moving average based on less than 5 years of data, which possibly means that all those past performance warnings that we all give actually do sink in for consumers, which is good. In anticipation of the choice dashboard, we also tested the return targets over different timeframes. So we tested it over different timeframes from the 10 years and the CPI figure that is used in the MySuper context. I have to say we found that consumers got very easily confused about the different timing. The other thing that we tested, and this is perhaps the most innovative development, we tested something called the Super Estimator. And what it is in an IT sense, and people here who know about IT are probably going to critique my terminology, it's a widget that sits at the bottom of the product dashboard on your website. And when people click on it, it goes to MoneySmart and to a cutback version of our particular superannuation calculator that's populated in part with information from your dashboard. And what it enables people to do is play around with the numbers a little bit and engage with it. I think this is some of the most interesting findings from the research. We found that people who reported lower levels of financial literacy really gravitated to the calculator and in fact almost bypassed the product dashboard in preference for it. People with higher levels of financial literacy, or at least reported higher levels, tended to gravitate to the product dashboard and not use the estimator. Now, the results of this obviously need to be worked through. We need to discuss this with Treasury. But what we see here is the potential that these two different disclosures sitting alongside each other and working with one another potentially cover all of your different consumer bases, so the people with lower levels of literacy and the people with higher levels of literacy as well. So as I say, I've covered this at a fairly high level today. Hopefully you will see more about this in the future. When we send this to Treasury, we will ask Treasury whether it would be all right for us to release this report as we did with the other consumer testing results and put it up on our website. And then you can see what testing has been done and comment on it. I also want to mention that from our perspective, we don't feel that ASIC necessarily has a monopoly on consumer testing by any stretch. If the industry is interested in undertaking some testing, I think that would be a fantastic thing. I want to talk a little bit at the moment about portfolio holdings disclosure. Now, portfolio holdings, like the choice dashboard, has similarly been deferred until 1 July next year, but the deferral arrangements for portfolio holdings are a slightly more complicated arrangement than just the straight 1 July date for the choice dashboard. In particular, the portfolio, or the part of the portfolio holdings regime that begins on 1 July next year, are the notification arrangements. So that means if you're a trustee, you're starting to tell people that you deal with that the money that you are giving them is superannuation monies, so that they are aware that they're going to have to report that information back to you. In terms of actual disclosure though, the first reporting date is the 31st of December 2015, which means you have 90 days obviously from that point to get the information up on your website. So in actual fact, there is no portfolio holdings disclosure that's going to happen until 2016. The one thing I did want to note, and I'm not sure whether people are well aware of this, I suspect this audience probably is well aware, but the one thing that our class order did not do is it did not move the royal assent dates. So what that means, and we've had quite a bit of feedback about this, it means that if, for example, you are entering into particular deals and arrangements, say with private equity partners today, when it comes to disclosure next year, assuming that you are still investing with those people, those arrangements are caught. And we are aware that there are particularly US private equity firms that are starting not to do business in Australia with superannuation funds because they think they will be caught up in this regime. The government is also well aware of this particular issue, and hopefully when the results come through from the consultation paper, this particular issue will also be addressed. So the current portfolio holdings disclosure regime does not have a materiality threshold, and it does have quite a complicated look-through arrangement, which I've alluded to in terms of the notification to the third parties. However, all of these topics were the subject of consultation in the government's consultation paper. So although we don't know exactly where this will land, I think the mere fact that the government is asking questions about a materiality threshold gives you some indication as to what the government is thinking about where this might head. I do think that there is a fairly good chance that the portfolio holdings regime that we see now in 1017BB of the Corporations Act could look quite different in, say, a year's time. And just in terms of where portfolio holdings disclosure might head, we've all talked about materiality thresholds, and I think that's a familiar territory. And we've all talked about look-through in the past. When it comes down to it, the types of things that I think that we need to be mindful of is the detail. But portfolio holdings, certainly in this case, is going to be a case of the devil in the detail. When you start to look at how this looks on a trustee website, for example, you need to start thinking about questions about will an asset be disclosed as a percentage of the overall fund? Is it presented as a percentage of an investment option, or is the fund as a whole? Or is it disclosed in dollar terms, or is it additionally disclosed in dollar terms? And what happens if you have offshore investments? What do you do with the currency? Do you also include hedging arrangements, derivatives? And if you invest, for example, directly in shares, and you also have managed investment schemes that invest in those shares as well, do you bundle all of those shares together in one place in your tables? All of these things sound like I'm being a little pedantic, probably, but this is the kind of thing that I think will make a difference to its usability. So when we do start to see draft regulations from government, I'd really encourage you to look at this type of detail. In fact, this audience is probably well placed to comment on some of that detail because, as I say, I think this is how people will actually engage with the information. It's absolutely no secret, I think, that ASIC is fully supportive of portfolio holdings disclosure regime in Australia, and we have been for many years. However, we do see that it's going to take quite a bit of work to make sure we get it right. I'll talk a little bit more now about executive officer remuneration and systemic transparency requirements, and I realise this regime started on 1 July this year, so you've all made your disclosures. This is all very familiar territory. However, this is fairly fundamental changes to the superannuation system. There's a level of transparency here that we haven't had previously. So making sure this beds down appropriately is going to be very important from a regulator's perspective. One of the things that we did was obviously a regulatory guide and a class order to try to give trustees a safe harbour in terms of updating their websites. So in order to give a little bit of time, in order to get the information up on the websites, I'm sure you're familiar with this, but generally speaking, for the executive officer remuneration requirements, you have up to 4 months after financial year end, and in relation to the systemic transparency requirements, after a change has occurred, it's generally 20 business days after that event. However, the class order that gives you the safe harbour also does a little bit of other relief work as well. And I realise, because David Haynes pointed out to me in no uncertain terms how inappropriate it was that ASIC had done a class order at the very last minute on this, I thought I'd better mention today what is included in those additional points in that class order, because it's not related to the safe harbour. It just happened that the safe harbour class order was there. It was an appropriate vehicle for us to put these changes in. You can, if you have personal information about somebody that you would otherwise have to publish as a result of Section 29QB, you can redact that information. So for trustees out there, for example, who have trustees that have, or governing rules that have schedules with members' names on them, you can redact that information. The other, and possibly the more controversial element of this relief relates to subplans. For 1 year, until 1 July next year, we've delayed for public office subplans some elements of the Reg 238 requirements, particularly relating to PDSs. And this is obviously in relation to the fee disclosure and the disclosure of the different arrangements that some of these trustees have with different employer groups. There was some concern around the commercial sensitivity of that information. The government expressed an interest in thinking about this a little further and undertaking some further consultation. So that's the reason for the class order that's moved that timeframe out by a year for the sub-plans. As I've mentioned, Section 29QB is something that we are keen to take an interest in because we want to see how these reforms bed down. So you can expect that there will be a certain amount of surveillance activity focusing on 29QB. We'll obviously bear in mind that we have a facilitative compliance message out in relation to 29QB, so it's not that we're trying to be heavy-handed about it. It's much more to see how the regime is working or whether it's not working at all. We're also very supportive of the industry developing industry standards about some of these disclosures, and I know AIST is looking particularly at proxy voting, and that's something that we're fully supportive of. I also thought I'd mention some things that are coming up from ASIC. So we're now moving into the particular reforms that are... There's still some work going on, and these are some consultations that are coming from ASIC. Turning first to fees and cost disclosure. Now, this regime did start in full for managed investments and superannuation on 1 July this year. However, you've probably seen that we released a report in July looking at fee disclosure in the superannuation space, and what we found, and I don't think it's any surprise, is that there's a certain amount of inconsistency in fee disclosure, which obviously hampers comparability for consumers. Now, we looked at this, and we looked at the requirements and some of the feedback that the industry has given us about the disclosure regime that exists under Stronger Super. And we thought that there might be some places where we could do a class order that would give some greater clarity as to the requirements, and that again might help with comparability. In fact, that consultation paper and class order has been drafted and has been circulated for soft consultation. It will very shortly be circulated publicly, so you'll see it on our website, and I'd certainly encourage you to have a look at it. The types of areas that the class order covers, and I don't think this will come as any surprise, it looks at issues around double counting. I mean, obviously we don't want double counting of fees, so we don't want something in an investment fee and ending up in your indirect cost ratio, but we wanted to make sure that the drafting was absolutely specific about this. Also, we want to give some clarity about how far you should go in terms of look-through when you're calculating your indirect cost ratio. And we wanted to tidy up some of the obvious issues that are in the current drafting of the regulations. You're probably well aware, but the managed investment template refers to employers in its headings, which clearly was never intended for managed investment schemes, it was intended for super. So there's bits and pieces like this that we'll also tidy up. So as I say, I'd encourage you to comment when you get a chance and when you see it released up on our website. And just to mention that this is ahead of a more comprehensive update to RG97, which is our fees and costs disclosure regulatory guide. The next piece of consultation is in relation to 29QC. Now, 29QC has a bit of an interesting backstory, which no doubt everybody knows about. It's been a very difficult section to implement. So earlier on this year, the regulators wrote a joint letter to the industry and said, look, this is how we think this section could work. And we thought we took a relatively moderate view of the requirements, recognising that they can be quite difficult. We got a lot of feedback to the letter that we sent. In fact, we got so much feedback about how difficult the section was, ASIC made a decision to turn that section off for a year. And in fact, 29QC will not apply until 1 July next year. The reason for turning it off, though, is obviously to undertake some further consultation with you. We won't just turn it off and have it restart again next year. We're having done absolutely nothing. And I wanted to flag some of the things that we're looking at in terms of that consultation. So, for example, it's the things that were covered in the letter. We're looking at whether 29QC should apply to performance information. So should the APRA data standards dictate what net investment returns ought to look like and where net investment returns ought to be used in your disclosure material? Should APRA's forms, for example, have something to say about the fee definitions too? And should APRA's forms define things like asset classes for the purposes of strategic asset allocation in your PDSs? And then there's the final, a particularly thorny issue we found. Should the return target in the product dashboard align with the investment objective in your PDS? I should say in the outset, ASIC is expecting that the answers to a lot of those questions might be no. So we're not starting from the position that we want Section 29QC to apply in all cases. But these are just the things that we thought we'd get some further feedback on. Obviously, it will also be open more broadly to see whether there are other areas we haven't thought about yet where you think actually 29QC should apply. It is fair to say that both regulators recognise that the section needs some parameters put around it in order for it to be workable. So we'd encourage you to give your feedback when you see it. In terms of its timing for release, we expect probably mid to late October. Our aim is to have this closed for consultation just before Christmas, and hopefully a release of a regulatory guide and a class order probably by March next year to give everybody time for when the section restarts again on 1 July next year. So that's broadly speaking the timing that we've got in terms of the consultation paper on fees and costs, on Section 29QC, sorry. Now, I'm going to use this slide, and I know that that's probably going to be quite hard to read. So this is something that we've prepared, and it's been available on our website as well. I'd encourage you to have a look at it if you do want to have a look at our website. This is a very quick summary of where everything is at with Stronger Super, what's on delay, what's not on delay, what's already started, what the class orders are that apply to it. I won't go through it in detail because essentially I've gone through it in this presentation in any event. It's also included in our letter to trustees that we sent out a few weeks ago now, and that letter that we sent to the trustees is also available on our website on the superannuation page under the What's New heading, and it specifies all of the relief and guidance that we've given and where you can find further information about it. Just in closing, I wanted to mention very, very briefly, so I'm running out of time, that we will be undertaking surveillance work in relation to Stronger Super, and I mentioned that in the context of 29QB. We'll also do some more specific Stronger Super surveillance work where we may serve notices on trustees, do on-site visits, and look more comprehensively at Stronger Super implementation. And this would be right across the board, so disclosure-related requirements, complaints handling requirements, and intra-fund advice as well if trustees have an intra-fund advice model that they're using. So to get a more general sense of how the regime is starting to work for the industry. We also continue to have a focus on advertising, and no doubt you've seen recent media releases from ASIC where we're looking at and have taken action in relation to some advertising. That will continue for the foreseeable future. And certainly our SMSF task force, which many of you are probably aware of, is focusing on advertising in a social media context. So, for example, on Twitter and Facebook, they're starting to review information, property spruiking, SMSF promotion in those types of environments. And they have specifically asked me today to mention that to you because they thought that perhaps you may see some of those promotions before we do. If you do see things that concern you in the SMSF space, we're certainly keen to hear from you.